Hi, Matt Bernstein here with Low Cost Hustle, here to talk to you about the historical performance of the stock market. There are numerous websites out there offering free historical data on the stock market. And if you're willing to pay, there are some that offer even more in-depth data. I like to use Yahoo Finance because it is free, simple to use, and meets most of my needs. There is also the convenient option to download any set of data right into an Excel spreadsheet for you to do with what you like. When measuring the performance of the stocks that we own, it is useful to have a benchmark to compare with so we know how well we are doing. From 1926 to 2009, the average rate of inflation was about 3%. This means that each and every year, the cost of goods rose by about 3%. And so if you pay $10 for a watermelon today, you can expect an identical watermelon to cost $10.30 a year from now. And in 10 years, that same watermelon will now cost you $13.44. What this really tells us is that money under our mattress loses value over time. And so to keep our value from degrading in value, it is a good idea to invest in things that grow faster than the inflation rate of 3%. Money markets typically have the lowest earnings potential of the investment classes, with a historical return rate of about 3.7%. If you invested your $10 in a money market instruments, then in 10 years you can expect to now have $14.38, enough to buy a $13.44 watermelon, and have some change left over. As you can see, we've successfully beaten the rate of inflation, but only barely. Bonds fared a little bit better during the same time period of 1926 to 2009, averaging a return rate of 5.5%. The same $10 investment in bonds will be worth $17.08 in 10 years. We made some money, but as you can guess, there are better alternatives out there. If you wish to grow your money faster than this, you must find other investment avenues. The truly great thing about the stock market is that it offers the opportunity for much quicker growth than either bonds or money markets. Large cap stocks, those that represent the largest companies in the world, Coca-Cola, ExxonMobil, and the Microsofts of the world, have a 9.8% return rate over the same time period, 1926 to 2009. And after 10 years, our $10 is now worth $25.48. Small cap stocks are those that represent comparatively smaller companies, have an even more impressive 11.9% return rate over the same period. In just 10 years, our $10 has more than tripled to $30.78. You can now buy 2 watermelons for $13.44 and still have money left over. The large cap and small cap average rates of return are calculated using every stock that meets those size qualifications over that time period. And so when these averages also include the stocks of companies that floundered or even went bankrupt. So think of it this way. If you picked 100 small cap companies completely at random, meaning some will do great, some will do okay, and some will go bankrupt, you can expect to receive an average rate of return of 11.9%, which means if you've had a knack for picking small cap stocks that did not go bankrupt, you could expect a higher than 12% return rate. So when we talk about beating the market, we literally mean achieving the higher rate of return that when the stock market averages on its own. For comparison, my brokerage account lists my average rate of return at a little over 44% each year since its inception. Over the same time period, a little over 5 years, the S&P 500 has averaged returns of just over 17%. And so you can see that I was able to earn 27% more than the market over the past 5 years. In finance, the returns we generate above and beyond the benchmark are known as alpha, meaning I was able to generate plus 27% alpha. So what you want to do is set goals for yourself, and that is to strive to beat the average market return of 12% each and every year, because otherwise you might as well just pick stocks at random.